Hey, good afternoon, everyone. My name is David Friedman. I'm counsel at Wagner Sidlofsky and co-chair of this Lunch and Learn seminar or series of seminars on issues in family and estates law, together with my colleague Peter Neufeld. The topic that we're going to be looking at today is estate freezes for beginners, and this is from a planning perspective. There's a paper that was prepared that should be available to you in the chat bar. If it's not there, it'll be there momentarily. Also available in the chat bar for download is a certificate of attendance. Two things to note. First, this is being recorded. Second, I'd be grateful if you could mute your microphones at all times unless you're asking questions. And after that, I'd be grateful if you could mute yourself again. We have three presenters today: Raquel Levine, Howard Zerker, and Denise Batac. Raquel Levine is a graduate of McGill University and Osgoode Hall Law School. She's a solicitor with a practice that includes trust and estate planning as well as corporate and commercial work, and she is counsel to Wagner Sidlofsky. Howard Zerker and Denise Batac are both CPAs at the firm Crowe Soberman. Howard's a consultant in the audit and advisory group and is a graduate of the University of Toronto. Denise is also a graduate of the University of Toronto and is a partner in the firm's tax group. And both are experienced in private client and commercial matters and have expertise in respect of planning involving trusts and corporate vehicles. I'd like to thank our sponsors, Scotia Wealth Management, Brith, Epstein Cole, Concentra Trust, BMO Private Wealth, TD, Torque and Mains, Solus Trust, and Weirfolds. This program is complimentary due to the generosity of our sponsors. If you enjoyed our seminar, we ask that you consider making a donation to the Brith Canada Food Program if you haven't already, and there should be a link to that in the chat. Before we get going, I'd like to introduce Rich Robertson of Brith. Mr. Robertson is the Director of Research and Advocacy and is here to tell us a bit about that organization and its charitable work. And so I will turn this over to you, Mr. Robertson.
Thank you so much, David. Thank you, everyone, for having me today. I'd like to share with you a really important initiative that was just launched by our organization in light of the continued rise in the levels of anti-Semitism across Canada. We have proactively launched what we are calling our 7-point plan to tackle anti-Semitism, and we've shared this with governments at the provincial and federal levels across the country, and we are hoping for it to be endorsed, adopted, and implemented to help us stem the rising levels of anti-Semitism that are currently facing Canada's Jewish community. I just wanted to briefly share with you the 7 points. The first is to amend the criminal code to better assist in the combating of hate. This includes strengthening the penalties for hate crimes, a legal framework for preventing the wearing of masks at protests, broadening the definition of hate speech, criminalizing the display of flags and/or emblems of listed terror entities, and stronger enforcement of penalties for criminal code offenses related to hate crimes. The second point is a comprehensive listing of terrorist organizations. Canada needs to continue to proactively update the list of terror entities in this country. Third point is to eliminate the importation and exportation of hate and terror. This can be done through a national ban on elements that promote hate speech, additional enforcement, and accountability for those who engage in acts of hate speech. The fourth point is to ban rallies that incite hate and that support terror entities and sanctioned regimes. The fifth point is an all-of-government approach to the adoption, implementation, and application of the IRA definition of anti-Semitism, which has already been adopted by the majority of Canadian provinces and by the federal government. The sixth point is to proactively confront anti-Semitism on campuses. And the seventh point is to proactively confront anti-Semitism within our elementary and secondary schools. If you would like to learn more about our new 7-point plan, how it can be endorsed, and how we hope that our provinces will adopt and implement it, it can be found on our website. Thank you very much.
Terrific. Thank you so much. Now we can turn to the issues proper, and I would invite Howard to take it over from here.
Thank you, David. I appreciate the handoff. Let me just share my screen. I have a PowerPoint presentation. Let's make sure this works. Of course, that shouldn't have done it, but there you go. Can we see the presentation? Is it currently shared? Good. Okay, excellent. Okay, let me introduce myself. David's already introduced us briefly. Our bios are online if anybody wishes additional information. My picture's a little bit old and I've aged a little bit, unlike my co-presenters who don't seem to be aging. I am going to take this opportunity to give you a little bit of an overview of the agenda. And I'm going to ask Denise and Raquel to address some of the issues with regard to estate freezes and planning. So our first discussion point is key terms to know when discussing estate freezes. As this is a presentation for beginners, we're assuming that people don't know a lot. And as a result, we're taking the opportunity to educate people on various terms that we will be using in the presentation. What is an estate freeze? We'll briefly talk about the lifetime capital gains exemption and how it plays into effect in an estate freeze. When to implement an estate freeze, potential disadvantages of implementing an estate freeze, and additional factors to consider when implementing an estate freeze. If you have questions on anything, we encourage you to put them through on the chat. Denise should be monitoring the chat. If there's anything critical as we're going through it, we'll address it. If not, we'll address it at the end. There'll probably be 10 or 15 minutes to take questions at that point in time. So, pardon me. Estate freeze, key terms and concepts. Raquel, can you possibly give us a little bit of an overview of some of the key terms and concepts of an estate freeze?
Yes, thanks, Howard. Okay, so we're going to go through 6 terms that are going to be used in this presentation and are used in the paper, and it's best if everyone is on the same page as to what they mean. So capital gain. So I think people have all probably heard that word in the news. They might hear it in their practice. So a capital gain is a gain that a person has on the disposition or sale of property that's considered capital property. And so that would be something that is usually an investment or something that's held for a period of time. To give you some examples, you might own shares in a publicly traded company. We're going to be focusing today on shares in a privately held company, but it could also include certain types of real estate. So that's, if you use a stock market example, if you buy shares for $8 and you sell them when they're $100, you're going to have a gain, and that gain will be characterized as a capital gain. The next is a deemed disposition. So I was just saying that when you sell something, you might have a gain. Now, there are times when, for the purpose of calculating your income tax, CRA decides you have a gain or a loss because they have determined that based on the circumstances, you have disposed of that property, even if you did not actually sell. So if I were to sell my shares to someone, I'd have a sale and I'd have a disposition. But there are circumstances, which we'll get into, where the CRA says, it is as if you have sold your shares, and we're going to calculate a gain or loss for you. We're also going to talk about two types of corporations. Okay, one is a holding company, or we would call it a holdco, right? And that is typically a company that is not itself conducting active business. Okay, so it might be owning investments, portfolios, GICs, mutual funds. It could own like an investment portfolio, or it can own other companies that are private companies. So you might have a person who owns a holdco, and that holdco owns the next item on the list, which is an operating company or opco. And the opco is what's doing some sort of day-to-day business, right? So if you manufacture pencils, the company that is doing the manufacturing, that's typically what we would call the opco. It's operating. And if it is owned by another corporation, then that would typically be called the holdco. Okay. Now, a trust. So we're going to refer to a trust sort of like as if it were an entity, but it's really a relationship. Okay. It's a relationship where you have the ownership, the legal ownership, the title of an asset in one name, and the beneficial interest or the equitable interest, the proper ultimate use of it belonging to someone else. Okay. And we're going to look at a trust typically in terms of a discretionary or family trust, where you might have people who are trustees. They own shares or other property in their legal name, but they're holding it on behalf of other individuals who we will call the beneficiaries, right? And they're the people ultimately entitled to call for those assets. And then I want to touch on shares. Okay, so what are shares? Shares are sort of a measure of, it's a unit of ownership in a corporation, and that could be in a holdco, in an opco. Any type of corporation would have shareholders, okay? And the shareholders have different rights depending on what kind of shares they have. And we're going to be talking about two types of categories of shares. One will be called common shares, and one will be called preferred, or sometimes people call them preference shares, right? And the rights of those shares are set out in the articles of incorporation of a company. And typically you're going to be talking about a few things. One is, how many votes does each share get? Two, is it entitled to dividends or not? Right? And three, what rights do these shares have on like dissolution or sale? So if the company were to fold up, or there were not enough money and we had to distribute, how are these different shares ranked? Okay, so a person or another company will own shares, and the shares will represent ownership in a company.
Thank you, Raquel. Let me just move this on. Denise, can you give us general terms and an overview of a freeze transaction, please?
Absolutely. So now that you've got...
Oh, you're cutting in and out. Denise, let's see. You're on. Did we lose her?
Shall I take over in the meantime?
Sure.
Okay, and then Denise, will be much better than me, will come in as soon as she's back. So the freeze transaction, so we're going to touch on those concepts that we looked at before, but we're really trying to control.
You guys can hear me.
Okay, we can hear you.
I'm so sorry about that. My Zoom just crashed. So good old technology.
All right.
Fun with it.
Okay, you're back. I only got 3 words into your slide. Go ahead.
Okay, great. Right. Okay. So now that we've got the lingo down, let's talk about what a freeze transaction is. And you've heard this concept, or maybe you've heard this concept in this word of freeze. You know, it's very common. I'll call it in the estate planning word that you hear this concept of freeze. But let's talk what a freeze really is. Basically, a freeze is basically taking a snapshot of private company shares at a given point in time and saying, I'm going to freeze the value of that company as of today And the growth of the company is going to be attributed to new shares. Using Raquel's example of there's different classes of shares, this is where the different classes of shares come in place. So the real concept is saying, okay, I have my company. As of now, I want to have a snapshot of my company now, and any future growth of my company, I want it to go to my successors. So it's often achieved by, I'll say, exchanging. So if you had common shares in your company now, you would exchange it for what we call those fixed value preferred shares. It's really a fancy way of saying that at the end of the day, I'm going to exchange my shares for these shares that are only worth the value as of that day. And it's really saying that, and the reason why it's preferred shares is you may have preferred entitlement, on liquidation or on the assets. So you can make sure that, you get that value back that you've frozen effectively at that point in time. What a freeze really lets you do, like I said, is give that growth of the shares over to your successors. So it could be your succeeding children that you want to, ultimately have ownership in your company. And it really allows them to do so without having to go out and buy the shares from you now. If your company's worth 10 million now, you wouldn't want, if you wanted them to have a 50%, let's call it a 50% stake in the company, you wouldn't want to all of a sudden have them to fork out 5 million. By doing a freeze, you could say, I'm going to keep the 10 million I have now, and anything going forward is going to my children. And, with no financial commitment for them to get that ownership going forward. And also it allows you to defer effectively paying income taxes on the disposition. So using the example again of if you wanted your children to have a 50% interest in your company, if you went and sold 50% to them now, you're going to be taxed on 50% of that gain, 50% of the shares and the gain on that 50% in your personal hands. So rather than triggering that gain, you can effectively defer paying the tax on your 10 million of shares until such time that either dispose of them in the future or you have the deemed disposition on your passing. And so that leads me into the last point. So when you pass away, you are deemed to dispose of all your assets at their fair market value as of the date of passing. A freeze transaction is very, very common in an instance where you say, okay, my company's growing to 10 million. That's all I'm going to need for the rest of my life. I'm not going to need more than the 10 million. So why continue to hold shares up until, me passing and then having a deemed disposition effectively on my passing when I can have the future growth go to my children, and that future growth isn't going to be taxed on my passing. All I'm going to be stuck with paying tax on is this 10 million that effectively I want to freeze at this point in time, or I guess the remaining of the 10 million if you kind of slowly unwind that during years as you need the cash.
Thank you, Denise. We have an example of a freeze transaction. There are many examples of a freeze transaction. We thought we would try and put up a relatively simple example. And I would ask Denise to sort of walk through this example, please.
Absolutely. Yeah. So to give you an idea, like we've talked about what happens, exchanges of shares and what a freeze is, but I don't know about you, I'm pretty visual. So I always like to give a visual example. So let's look at the before, before kind of diagram. We have, a parent that fully owns shares in an operating company, and that operating company is worth 10 million. And parent says, you know what, that 10 million is going to be sufficient for me to live off of the rest of my life. I don't need more than the 10 million. So now is a good time for me to freeze my company. And so you could effectively do a share exchange where parent takes their common shares and says, I'm going to exchange them here, company, take back my common shares. I'm going to get preferred shares. And these preferred shares are going to have no greater value than the 10 million as of the date of freeze. And then going forward, we use the example of a trust. I'll get into that a little bit in detail, but let's use the example of a trust. A trust then subscribes for the common shares. What that means is then that trust would have the growth shares going forward. And so with that trust, you can have all this flexibility in terms of who the beneficiaries are of the trust. You can make it fully discretional. What does fully discretional mean? Meaning that if you want to give the share, say you have one child that's actively involved in the business, and you have other children that, I'd say are more passive investors in the business. You could make a decision to say, hey, child who's actively involved in the business, you get a bigger stake of this company than the other children. That's up discretionary, where ultimately at the end of the day, you can have that discretion in terms of value and who owns what value effectively in the company. We use the example of a trust because it's kind of a nice vehicle in the sense of there's still some level of control, I'd say, so to speak, that you have. Depending on who you choose as the trustees of the trust. And you have to be careful that we don't walk into lovely attribution rules and income coming back to you. But it still allows a little bit of discretion and I'd say control, meaning that let's use the example of you have 3 children, like I said, 1 more involved in the business, 2 others that aren't. You can have that discretion on how much each child effectively can ultimately get of the businesses, of the value of the businesses. You may have 1 child that's a bigger spender than the others, so you may not want to give them their shares right away. You may want to give some other shares to other children earlier on. It really gives you that flexibility to do that. Versus if you put the shares, using this example, you don't necessarily need a trust. You could have your children own the shares directly. Whoever your successors are, you can have them own the shares directly. Really is based on their personal situations and your personal circumstances, and whether you want them to be invested right from day one, or whether it's a situation of you want to have that discretion of who gets what over time, and you don't really want to make that decision right now.
Thank you. So we talked about briefly the lifetime capital gains exemption. So there's an opportunity in the freeze transaction to crystallize the lifetime capital gains exemption and or to expand it to multiple family members. So in Canada, currently there is an exemption where a capital gain on the sale of qualifying small business shares has an exemption on the first $1,016,836. It's soon to be, assuming the liberal legislation for the changes in capital gains rates passes law, it will be increased to $1,250,000 shortly. What that means is, if I were to own shares in a private corporation, Canadian controlled private corporation, and I sold them for $10 million, for argument's sake, I sold the shares, the first $1,250,000 would be tax-free. The remainder, being $8,750,000, would be a capital gain subject to tax at the current capital gains tax rate under the new budget. In a freeze transaction, you have the opportunity to crystallize that lifetime capital gains exemption. There's always fear that the government could eliminate the lifetime capital gains exemption. And by utilizing it at this point in time in a freeze transaction, you are effectively ensuring that you or your estate will get that value and reduce your tax burden ultimately on the sale of the shares or on death. In the case of the example that Denise previously discussed, where a trust was implemented, or even if it's a direct ownership through a corporation, and you're bringing other family members into it, you will be able to utilize their lifetime capital gains exemption as well. So if you have 3 children that are going to be ultimate beneficiaries of the trust, you now have increased the number of participants in their lifetime capital gains exemption from 1 to 4. And so you now have approximately $5 million of exemption that you may be able to utilize. And you can see a trust doesn't restrict you to utilizing children's lifetime capital gains exemption. There are other beneficiaries you could bring in, like parents, like in-laws, like grandchildren. So there is opportunities to double dip, triple dip, quadruple dip into the lifetime capital gains exemption. When our estate freeze is implemented, Raquel, could you please give us an overview of this?
Yeah, sure. I just want to give a summary to what Denise was talking about before that I think the audience might find helpful. This is something that typically when clients approach me first before bringing in their accountant is that if you sort of imagine like a Venn diagram where like one circle is the number of legal things we could do to achieve your goal, right? And then the number of like tax options you have, like there's really a slim middle. And so while there might be a lot of, let's say, corporate ideas as to how you could transfer ownership between children, or, you know, I'm going to give the shares, I'm going to sales for $1, all these different ideas that you could think of, these are, from a corporate law point of view, might work, but from an income tax point of view, will be disastrous, right? And I think the reason that, you know, I'm here with Howard and Denise is to show the importance of having a corporate side and a tax side coming together, right? Because with only law alone, it's not enough to properly be advising the client. I think that you'd be putting yourself at a very big risk as a lawyer, and I think we'll get into some of those ideas a bit later, but that's just something that is really important to remember as we go through this. So,
well, the key is that you need a team of people to help you through this transaction, and typically accountants and lawyers are involved. I am not a tax practitioner. I'm a general practitioner. I deal with corporate and commercial accounting. I see myself as the quarterback, bringing in the tax professional, whether it be a legal tax professional or a accounting tax professional, plus a corporate tax lawyer needs to be involved. And the team really needs to dive into what the objectives are, your personal objectives are, and come up with a plan that makes sense to meet all those objectives. Sorry to interrupt.
No, I think it's a good point, because also you have clients tend to have like, let's say 8 number 1 priorities. Okay. And as a professional advisory group, you know, the lawyers and accountants all together, we can try and help them prioritize those, because, you know, if they really, really feel strongly on priority 6, you know, and they kind of don't care about the other ones as much when it gets down to it. So we're going to try and figure out a transaction that will hit priority number 6. Our job is really to sort of fully inform them as to what are your options and what are your risks. So when do I see these implemented? So I think there will come a time, very often it will start with the general practitioner, like someone like Howard, who is meeting with the client at a very regular touch point, minimum once a year, where, you know, the value of the company is growing, the founder is aging and considering either leaving or dialing it back, and may or may not have like an actual third-party successor in mind, right? But they see that as on the horizon, things are going well, and they, you know, it's naturally they want to benefit, hopefully naturally, they want to benefit their children and their family, okay? And they're starting to think about their own mortality, and they hate paying taxes. And so those things kind of come together, increased thought about mortality and hate of paying taxes, which are like, I think those 2 certainties of life, death and taxes, they kind of come to a head, and they're thinking, there's got to be something I can do. Sometimes when you have people in your family, in the business, it becomes more obvious, because at some point the child may say, okay, you know, dad, mom, whomever, you know, I want to have more control, I want to have more say, and they may want shares which they will own directly or through their own trust. And so children working in the business may bubble the conversation up to the top. Typically before an estate freeze, you have like the founder who has, you know, the world's largest door plaque, right? Like CEO, secretary, president, treasurer, shareholder, director, everything is the founder, right? And at some point, they're looking to diversify their own life, okay, and trying to get something going. Especially like the more powerful or commanding the founding person is as a presence in the family, the more important it is that they are the ones initiating this, because they are typically have some moral cohesion on the family and are able to say, listen, this is what we're doing. And they all know, well, when founder says that we're interested, and it'll help to bring people in and maybe take some load off. Sometimes it's slowly, and the new shareholders who come in are very, very slowly, almost at like a glacial pace coming in. And this is really just like a wait until this guy passes on. And sometimes it is really a bigger active role, depending on what the nature of the business is.
I see other circumstances where an estate freeze often comes into play. Prime example, I have a client that is in the software development business. They've had rapid growth in their business. It's gone up in value significantly. He is looking at a likely exit in the next 5 to 10 years. And between that point in time of today and 5 and 10 years, when there's ultimately a sale, there is going to be significant growth in the value of his business. And he's saying, I don't need all that. I can defer some of that tax. Potentially, I can utilize my kids' lifetime capital gains exemption. Why wouldn't I look at an estate freeze right now?
Yeah, absolutely.
Denise, key factors to consider when deciding to implement an estate freeze?
Yeah, I mean, you always get the question of, is now the right time? And sometimes I have clients, kind of knocking on my door saying, oh, I heard about an estate freeze. I think I should do one now. It's not a cookie cutter approach to everything. We really have to look at your circumstances and whether, freezing at that time is right for you. One of the things you look at is your net worth. Do you have enough net worth right now that's going to meet effectively your needs until you pass away? You're likely in a situation then when a freeze makes sense. Do you have more, using Howard's example with his fine, do you have more than enough right now that you're not going to need that, post passing away, and you want to leave the rest of the value that's going to grow to your successors? That's really, I'd say, a key factor. Another key factor is saying, what is the value of the company right now? Is this the right time? Is it a booming time? Is this a really low time? Really looking at that and saying, and what I mean by the booming or really low time is, absolutely you'd want to freeze it at this point in time, and mitigate that tax if this is all the assets that you need. But if it's a situation of, oh, well, the business is only going to grow maybe $1 million from here on in, this is pretty much the growth of it. And we've realized all the growth of this right now. Freezing right now, given, the complexities that you've kind of seen associated, may not make sense, right? So you have to be practical in the circumstances. And then once again, really, where are you at this stage of life in terms of having your successors of your business? Is this the right time to effectively pass over the future growth to people, whether it's family members or children or whatever the case may be, even though your children are your family members. But, really looking at whether it's the right timing. Do you want your family to start participating in it now? Sometimes people will talk to me about doing an estate freeze and they have really young children. You have to remind them that trust, if you're implementing a trust structure, for instance, at the end of the day, those children, when it's 21 years, you have to make a decision because a trust only has a 21-year life. You have to make a decision what you're going to do with those shares. If your child's 2 now, do you really want to be putting shares in their hands when, they're 23? You really have to look at the circumstances and the timing and making sure that it's the right time for you. Now we'll pass it off to Raquel to talk about some additional considerations.
Thank you, Denise. I didn't get
No
the
worries.
Denise, I'm a very, very mature 23-year-old, so I'm going to answer what you just said.
Actually, it's funny, we're laughing about this. I did have a friend that inherited her grandparents' trust at 23, and the next day turned around and bought herself a brand new Mercedes-Benz. And I can only tell you how excited her grandparents and parents were about that.
Yeah.
It
That's
happens.
the face of disappointment right there. Yeah. Well, again, I don't know how big the trust was. That could be just a drop in the bucket, but sure, it's not a great first sign. That's for sure.
No, definitely not.
All right, so I want to talk about some other sort of like tax adjacent issues that come up in the context of doing an estate freeze. So, when you're bringing in these new shareholders somehow, either they're beneficiaries of a trust or you're bringing people in directly. You are bringing them in, and like you're not really bringing them in only for the high times of splitting millions of dollars. Like that is part of it, right? And if everything goes well, no one will really care about all the other stuff. But you have to also plan for the more challenging times, and also the time when founder's not there to have that sort of moral cohesion and an influence on everyone. And you're bringing people in as shareholders, and shareholders have rights. Whether there are rights that they have under statute and common law, there are rights that they have according to their share provisions, and they may decide, to everyone's dismay, to exercise those rights. And a shareholders agreement, which, I realize by the time you've gone through this whole exploratory thing and done a freeze, like people don't often have a lot of energy to do that, but you have to raise that with the founder and with the group. You're bringing in a trust that has beneficiaries, or you're bringing in individuals. They're going to have rights. Do you think it's good now, while there's sort of nothing active, no disputes, no concerns, to set up the expectations, right? Because the shareholders agreement is really a document about expectations, right? We can't use a document to make people behave well, but we can have a document to tell people how they should behave, ideally, right? And also talking about management structure, right? If the founder is still there, has a complete landslide of voting rights, and is doing things that maybe the beneficiaries of the trust don't approve, they're going to say, well, aren't we part of this? Like, aren't we supposed to get something? Even if it's a completely discretionary trust, people can have different expectations of what they thought would happen and how much control they thought they'd exercise, in terms of maybe it could be even spending, right? The company bought a new building, the company CEO got a new car. I mean, all these things. And sometimes it's the small things that just start, peeling away at the corners that can be the beginning of the end of, like, the one happy family that was just supposed to earn millions of dollars and multiply their lifetime capital gains exemption. So it's not that these things are reasons why you shouldn't do an estate freeze. It's that, you have to think about all these things at the same time, because we want to do two things. Number one, we want to implement the freeze. And number two, we want the freeze to be successful on a go forward basis. Because if you're just doing a great job today, and you fail to think about tomorrow, so a failure to plan is a plan to fail. From a lawyer point of view, there's always this question that arises: who's the client? So you're dealing with, like, the Smith family, okay, and you have the founder, and you have the corporation, you have the kids and the siblings, right? I think you as a lawyer have to set out who is your client, who are you primarily acting for, and who in this group should be going out and getting either ILA, independent legal advice, or ILR, independent legal representation, right? Because ultimately, it's going to be hard for you to have everybody in the group to have all of their best interests in mind. I think that's not a practical viewpoint, right?
Raquel, that let me interrupt. That
please.
raises a question that LB has asked in our chat. Do you recommend the spouse who is not related to the owner or the company obtain independent legal advice and sign some sort of post-marriage contract that she will not contest the estate freeze in the event of a subsequent separation?
That's definitely part of it. So we're going to go down, like, point number 4. We're going to talk about, like, family law issues. And so maybe I could just wait until we get to that point, because that's going to be my whole point. You can invite that person to come and speak. So absolutely, you want to tell people, again, this is about the future, right? This is what we're doing now. And while it's happening, everyone's very excited, and we're signing zillions of pages, and people don't remember how to sign their name anymore because they all do DocuSign. And, it's very exciting, and you can get swept up, and there's so many meetings but really, like, who are you representing? Because at the end of the day, when something goes wrong, I think it's pretty much the lawyer's fault, just assumed, right? But everyone's favorite line, well, I'm not a lawyer. Well, yeah, I know that. So anyways, you want to protect yourself, and also in terms of your scope, right, of what you're doing. So perhaps you need a joint retainer, number one, ILA and ILR, but also, what is your role, right? So I don't prepare tax returns, tax elections. I don't value your business, right? What am I? And in my engagement, right, I'm saying, here's what I'm doing, right? And sometimes I even just add what I'm not doing, right? Just so we're clear, right? I'm not your tax advisor, right? I am not putting together this plan or recommending you freeze at a certain value, right? You're responsible for doing all these things together with your accountant, right? So that as a lawyer, you're really taking responsibility for the portion that you control and that's within your scope of practice. Another topic is estate planning. So sometimes you have some kids who are involved in the business, some kids who aren't involved, kids who have a lot of money, kids who don't have a lot of money. Whenever you're dealing with your children and you're dealing with things in an unequal way somehow, so money and love get confused, especially after the death of the founder. Money equals love, and if someone gets more money than the other, that means they were loved more, and he never liked me anyways, and I used to sit in the bad part of the car, and he touched my side, and on and on and on. So I think that the founder needs to be careful, and I'm sure every lawyer has had to play therapist at some point, just trying to advise them on how to deal with their different children, their children's needs, and sometimes the kids need to be treated equally, even if their needs are different, right? Or they should be prepared for the consequences if they don't. And on the topic of drafting new wills, so once this freeze gets implemented, right, the asset mix of the individual is a little bit different, and the future asset mix might be different, or the value might be different. So at that time, it's a good time to consider revising the will, especially if perhaps you had a child excluded from your freeze, right? Maybe you have 2 kids in the business, you want to bring them in, you have 1 child not in the business. Maybe you want to actually now leave them another asset, leave them your house or leave them something else so that they are still receiving. And this is part of going into that, equalizing between the children. Before you owned everything, you were just going to split it, 2 ways, 3 ways. But now you don't necessarily own everything. Again, like your plaque has gotten shorter. You're still like a shareholder, may not be like the big shareholder. And then family law, really to that point of the person who mentioned in the chat, yeah, you actually have to, it is prudent, even though it's a discretionary trust, right? Family law is like the least commercial area, right? You can't just say, well, that's what the contract says, and so I'm sure family law will just, completely be okay with that. You have to advise them, you're going to be effectively bringing people in to share in value, right? That value will be something that your child will own as an asset. If your child gets divorced, someone will come calling, right? And the bigger the value, the bigger the phone call. So do you want your children to go get a marriage contract, right? Or cohabitation, or, depending on their marital status, right? That either lays no claim to the corporation, or they will take money instead of shares or something to deal with that. And then you bring in, people at Epstein Cole to advise on those issues. But these are things that you sort of, as the central legal place, like in the way that Howard is sort of the central accounting quarterback and really monitoring that things are in place for the freeze, you as the lawyer should be recognizing like what you are doing, what you're not doing. And it's important to tell the client, listen, I am not a family lawyer. Here are like 2 great family lawyers. I would love to introduce you right this second so that I clearly have introduced you to someone who's a family lawyer to talk about this, right? If they decide, I had a client who froze, brought his kids in. This company owns 40 buildings. And I begged him. I begged him like multiple times, verbally and in writing, please have your kids sign a marriage contract. And he said no, but I've advised him. He said, no, it's too late. We don't do that in this family. Okay. But I've told him, because later on, if I didn't tell him, and I didn't have that email like framed on my wall, no one told me I'm not a lawyer, right? So you're trying to limit those conversations.
Thank you.
Yeah.
Potential traps and pitfalls, Denise.
Yeah, so I mean, there's a lot of reasons. We've given you a lot of reasons on why you do estate freezes. Let's look at some of the things you need to be concerned about if you want to implement it, or things to watch out for. So we already talked about timing is key. is the business at its peak such that, there's going to be very little growth that's going to go forward to the successors? Is it really the right time for you to freeze at this point in time? Do you have enough net worth right now? So that timing is obviously very key. Another key important factor is making sure it's just planned and executed properly. I know, Raquel, Howard, and myself have mentioned it numerous times already about having, the right professionals and the right team together to plan this. Planning is key here. There's so many times where you say one party, comes up with the plan, and then, you've always I love that Raquel said it, like you've also always got to check back with your tax advisors on the plan, because so many times when the plans come up in place, you think, okay, this is fantastic. And just the way that it's structured, you may walk into these attribution rules. Attribution rules is really just a way of saying, ultimately, at the end of the day, hey, you meant to pass this asset to XYZ person, but I think you really did it for a tax benefit. So no, we're not going to let that happen. Basically, all the income on that asset's going to go back to, the transfer or the settler or whoever the case may be. And, with the lovely TOSI rules, so the tax on split income rules, the government's really trying to get away from the ability for, say, like an owner-manager business to split income with its family members. So we're not going to go into the great deal of the attribution rules that could apply or the tax on split income, but we wanted you to hear these terms and know these concepts to know that these could be issues that you walk across if the plan is not executed accurately and efficiently.
One of the questions from a viewer: can the owner founder be accused of reducing their assets and passing them on to their kids and taking away a value from their current spouse? That's a tough question. If the freeze is done correctly and the valuation is done correctly, the answer is no, because you're basically freezing your value at today's value. What you are doing is making a determination to pass any future growth in that value to the next generation. And yes, there's family law issues associated with that, and you need to bring in family law experts to assess the issues. But I would say the answer is probably no to that question. Last thing, we have working as a team, which we've already addressed somewhat. The only thing I would ensure that we have to add to the team, because when you're dealing with the freeze of a private business, there are valuation issues. And so nobody on this call is a valuation expert. There are firms and there are individuals that have designations as certified business valuators. And it is critical as part of a freeze transaction that a proper valuation be done, which sort of indicates that when you start to put the pieces together, you can see that you've got a lawyer involved, you've got a tax practitioner involved, you have your accountant involved, you have a valuator involved. It's an expensive proposition to do a freeze properly. And so it has to make sense in order to justify the value associated with the cost associated with the freeze. Okay. We are now at a point, it is 12:51. We have up to 10 minutes. I'm opening it up to anybody that wants to ask questions. You can raise your hand or even break in on audio. Let's just hope we don't end up with people speaking over each other.
Actually, I'm going to jump in. I think there was a question in the chat that I wanted to raise. The question is, if a family trust is the beneficiary shareholder of a holdco and the holdco owns shares of a CCPC opco, can the lifetime capital gain exemption be expanded to other members? The answer is yes, with proper planning. So if you have a situation where you have, let's call it trust, I guess that's my triangle. If you have trust and you have a holdco that then in turn owns an opco, The key thing that you want to make sure to be able to get the lifetime capital gain exemption is that the shares qualify as qualified small business corporation shares. And what does that mean? Effectively, the Canadian government doesn't want you to have a company that has a whole bunch of passive assets and being able to claim this lifetime capital gain exemption. The whole purpose of it is that the Canadian government wants to incentivize businesses to create, great businesses, grow great businesses in Canada, and benefit from that growth and development in Canada. So the idea behind it is that they really want to make sure that as of the time that you sell the business, to utilize a lifetime capital gain exemption, that the business is really 90% or more active assets. So what they're really looking at is making sure that, even if you have the holdco and the opco situation, if your holdco, I'll call is pure, that's the term we use in the tax world, but if it doesn't have any passive assets in it, you could still potentially qualify for the lifetime capital gain exemption, but you'd have to sell the holdco shares. What you often do in a structure like that, it's very common where you say to buyers, like, hey, you know what, right before the sale, I'm just going to amalgamate holdco with opco, and you're going to buy the shares effectively of just opco. And so you'd still, once again, get the lifetime capital gain exemption, assuming that the opco qualifies as a qualified small business corporation, which is also a reason why you want to keep, I'll call it holdco pure. If you're going to amalgamate those two companies together, whatever assets you have in that holdco is going to be sold away with the opco. So you'll want to make sure that you're retaining whatever assets you want to retain on a sale. I hope I answered that question.
You did. There is a question here that isn't really part of this seminar. Can you talk about how to protect the primary residence from probate? We could have an entire 2-hour conversation about probate. It's really very difficult to try and address that issue in this seminar, but the answer is yes, there are vehicles and ways to eliminate probate as part of an estate plan. And I would suggest that you speak to your professional advisors on this issue, be it your lawyer, who is a estate lawyer that is eminently capable of discussing probate planning, or a tax practitioner, or even an accountant practitioner. I spend a lot of time with my clients at this stage in my practice because they've aged as I've aged in terms of probate planning. So there's another question here, Denise. Well, is the frozen value of the business is relocated to the owner as preferred shares, the common shares are gifted to the children, then the value subject to probate would only be a residue of preferred shares not having been reimbursed to the original owner. Of course, this also creates an issue of losing of control of the owners, the original ownership. That's a mouthful. Again, I think that's part of the probate planning you would do as part of a detailed estate plan, and the freeze is one component of it. Probate planning would be another component.
There was one other question that was directed to. So the question was, how beneficial is an estate freeze as opposed to creation of a bare trustee with regard to protecting the estate from taxes, and which would be more beneficial if there are cross-border implications? So a bare trust effectively says, I'm going to hold title to the assets, but the legal beneficial ownership still sits with the individual themselves. So to be clear, that may minimize your probate tax, but when we talk about estate tax, that deemed disposition on passing, because you legally still own that asset, you are still going to be subject to that deemed disposition on passing. So that's why there's a difference between implementing a bare trustee relationship, which would potentially mitigate your probate tax upon passing, versus your actual, I'll call it like estate taxes, the actual tax you're going to pay on the deemed disposition.
Right. There's also, Denise, I just want to pop in that sometimes there's two different things. There's one, trying to minimize probate that we think will happen, and therefore tax will be paid even on things that you have as a beneficial interest. And then there's trying to avoid the scenario of needing to apply for probate in the first place.
Right.
And so like sometimes we have to look at what those two things are, because you might have like a condominium, for example. I find that that's one of the most irritating things people have to wait on for probate, because you're paying like this guaranteed monthly fee. Nobody's there. And they wish they could just sell it quickly, even if they have to pay the probate tax. And that's where like a bare trust might be helpful, because it allows you to sell it quickly. You might not be able to get out of probate tax, but you can get out of that like lag time associated with waiting for probate. So there's, just to your point, Denise, there are like so many different aspects of, we talk about probate planning, there's like avoiding the process, avoiding the cost, avoiding, and it's all, it all has to be
100%.
fleshed out.
Yeah. I
And
don't
then I
want to
think
run
the-
overtime, guys. It's 12:57.
Yes.
There is another quick question, which I don't think there's an answer for, which is, in your experience, how much does a company have to be worth to make this a valuable option for the client or the founder to do a freeze? There is no cut and dried answer to that question. Everybody's circumstances is different. It's really about the timing of when a freeze makes sense. And it's really something you need to speak to your advisors about. It's not something we can answer on a call like this, especially when it's 12:58 and we're trying to finish by 1.
Sorry, I just want to address one more question. Somebody raised a really good question to me about what if there's cross-border implications? It's a
Right.
really great question. When you're setting up estate freezes and you have your successors or non-residents of Canada, you really need to look at how you're implementing it to make sure that their host country doesn't create adverse tax implications from said structure. So absolutely, if it's one of those things, left hand always needs to know what the right hand's doing. It's very important when you have successors that are non-residents of Canada, you have all professional advisors involved, even those in other countries.
Thank you. David, back to you.
Thank you very much. I'd like to thank our 3 presenters for a truly excellent seminar. This was really wonderful. There was a ton of content, and I thought that we all learned a lot. I certainly did. So for those of you that have not yet downloaded a certificate of attendance, it's still available for you in the chat bar. We're looking forward to seeing you at the next seminar, which is in 2 weeks' time, when we'll be dealing with estate freezes, but from a litigation perspective. And our speakers for that seminar will be Claire Burns and Jonah Waxman of Weir Folds and Adam Brewer of Epstein Cole. If you haven't registered yet, there should be a link posted in the chat, and you can do so. And as a final reminder, there's a link to